Most people imagine retirement as a single destination, a moment somewhere in the future when the working years are finished and the savings finally take over. But something strange happens when people actually reach that point. Two retirees can have the exact same amount of money, the same investments, even the same lifestyle, and yet one of them sleeps peacefully at night, while the other constantly worries that the money will run out. Same numbers, same retirement, completely different experience. So what's the difference? To understand that, imagine two people who both retire at age 65. Let's call them David and Linda. Both spent decades working. Both saved consistently. Both built a retirement portfolio worth $1 million. On paper, their situation looks identical. David keeps everything in a single investment portfolio, mostly stocks and bonds. His advisor tells him the market will grow over time, so every year he withdraws money from the account to cover living expenses. At first, everything seems fine, but then the market drops. Not dramatically, just a normal downturn, maybe 15%. Suddenly, David feels uneasy because the money he's withdrawing for groceries, rent, and medical expenses is coming from the same account that just lost value. So he withdraws less. He delays travel plans. He cuts back on spending. The portfolio eventually recovers, but the feeling stays with him. Every market headline feels personal, because when the market drops, his retirement income drops with it. Now let's look at Linda. Same retirement age, same savings, same $1 million. But Linda structured her retirement money differently. Instead of one pool of money, she divided it into three. At first glance, it doesn't seem like a big change, but the effect on her life is completely different. Because when the market falls, Linda barely notices. Her lifestyle doesn't change. Her income keeps coming. Her stress stays low. And the reason for that difference isn't a better investment. It's a better structure. But before we get there, there's an important problem most retirees never think about. Retirement is not just one long financial event. It's actually a sequence of different time periods. The first few years of retirement are completely different from the later ones. In the early years, people travel more, spend more, experience the freedom they worked decades to reach. Later on, spending often decreases. Life becomes quieter. Medical costs might rise, but lifestyle spending tends to slow. And behind all of this is one silent risk that many people underestimate: timing. Not just how much money you have, but when you're forced to use it. Let's imagine a simple scenario. Two retirees both have $1 million portfolio invested in the market. Both plan to withdraw $40,000 per year. The market grows steadily for a few years. Then, suddenly, a major downturn happens right after retirement. This is called sequence of returns risk, and it's one of the most dangerous financial events for retirees. Because when markets fall early in retirement, withdrawals lock in those losses. You're selling investments when prices are down, and those shares are gone forever. Even if the market recovers later, the damage has already been done. It's like pulling bricks out of the foundation of a building. At first, it looks fine, but over time, the structure weakens. Now imagine that same scenario again, except this time, the retiree doesn't need to touch their investments for several years. They already have money set aside for living expenses. Suddenly, the market downturn becomes far less threatening. Because time is allowed to do its job, the portfolio can recover. And this is where the idea behind the three-bucket strategy begins to appear. Not as an investment trick, but as a time management strategy for money. Instead of treating retirement savings as one large pile, the money is separated into different time horizons. Each bucket has a specific purpose, and each one behaves differently. The first bucket is the most boring and the most important. This is the short-term bucket, money that covers immediate living expenses, typically the next 1 to 3 years of spending. This money isn't meant to grow. It's meant to be stable. Cash accounts, short-term bonds, very low volatility. Because this bucket has one job: to pay the bills, groceries, utilities, insurance, everyday life. When retirees draw income from this bucket, They are not forced to sell investments during bad market periods. The market could fall tomorrow, and daily life continues uninterrupted. Now, here's where the psychology becomes interesting, because knowing that your next few years of expenses are already covered changes how you experience market volatility. A market drop no longer feels like a threat to survival, it simply becomes background noise. The second bucket serves a different purpose. This is the medium-term bucket, money that will likely be used several years from now, maybe 3 to 7 years in the future. This bucket usually holds more conservative investments, balance funds, bonds, lower volatility assets. Its role is to slowly refill the first bucket over time. When markets perform well, some of the gains from this bucket move into the short-term bucket. Like water flowing between reservoirs, the system quietly replenishes itself. But the third bucket is where long-term growth happens. This is the long-term bucket. Money that might not be touched for 10, 15, even 20 years. Because retirement can last longer than many people expect. Someone retiring at 65 could easily live into their 90s. That's a 30-year financial timeline. And money sitting in this bucket has time to grow. This is where stocks, index funds, and growth investments usually live. Unlike the first bucket, volatility here is not a problem. Because the money won't be needed anytime soon, market cycles can rise and fall, and the long-term bucket continues compounding in the background. When you step back and look at the entire system, something subtle but powerful happens. Each bucket protects the others. The short-term bucket protects daily life from market swings. The medium bucket acts as a bridge between stability and growth. And the long-term bucket protects the future from inflation. Instead of relying on one investment strategy to do everything, each part of the system focuses on one job. And that separation changes behavior. Because most financial mistakes in retirement are not caused by bad math. They're caused by emotions. Fear during market drops, overconfidence during bull markets, or panic when headlines turn negative. When people feel like their entire retirement depends on the market's performance, every fluctuation feels dangerous. But when the next several years of life are already secured, the pressure disappears. Suddenly, long-term investing becomes easier, because you're not investing with money you might need next month. You're investing with money you won't touch for a decade. Now let's go back to David and Linda. Remember David, the one who kept everything in a single portfolio? Whenever the market drops, he faces a difficult choice. Withdraw money during a downturn, or reduce spending. Every decision feels heavy. Linda's experience looks different. Her short-term bucket quietly covers living expenses. Her medium bucket slowly replenishes it when markets perform well. And her long-term bucket continues growing in the background. So when markets fall, she doesn't need to react. She simply waits. And waiting, in investing, is often the most powerful strategy. Because markets eventually recover, but panic decisions can permanently damage a portfolio. The three-bucket strategy doesn't eliminate market risk. Nothing can do that. But it changes when that risk matters. And timing, in retirement, is everything. But there's an even deeper insight behind this approach. Because the real purpose of retirement savings is not maximizing returns. It's creating reliability, income that arrives consistently, peace of mind that daily life is secure, and space for long-term investments to grow without interference. When all your money sits in one place, those goals compete with each other. You want growth, but you also want stability. You want liquidity, but you also want higher returns. The three-bucket strategy separates those goals. One bucket handles stability, one handles transition, and one handles growth. And once people understand this structure, retirement planning begins to feel less like gambling on markets and more like designing a system. But there's one final detail that makes this approach work: maintenance. Because buckets aren't static, they need occasional adjustment. When markets perform well, money from the growth bucket can refill the medium bucket. When the medium bucket grows, some of it replenishes the short-term bucket. It's a slow, deliberate flow, almost like irrigation channels feeding a field. Each part supports the others. Over time, this structure can make retirement income far more predictable, even when markets remain unpredictable. And that predictability changes something deeper than numbers. It changes behavior. People spend more confidently. They make fewer panic decisions. They stay invested during volatility. And, ironically, those behavioral advantages often lead to better long-term outcomes. Because successful investing isn't just about choosing the right assets, it's about building a structure that helps humans behave rationally over long periods of time. The markets will always move, sometimes violently, but a well-designed financial structure absorbs that movement without disrupting everyday life. Which brings us back to the strange observation we started with. Two retirees can have the same amount of money, the same investments, the same financial future, yet one feels constant anxiety, while the other feels calm. And the difference often isn't the portfolio, it's the architecture behind it. Because money alone doesn't create security, structure does. And sometimes the most powerful financial strategies aren't about earning more, they're about organizing what you already have, in a way that lets time work quietly in the background. Because retirement isn't just about having enough money, it's about building a system that allows you to stop worrying about it